Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And as promised and as shared yesterday, we have the author and a returning guest, Mr. John Wake, who wrote the article, The Fundamental Reason Why Home Prices Must Fall or Will Fall This Fall. How you doing, John?
Good. Glad to be here, Mike.
Yeah, I just have to say, I really appreciate how you let data drive you, and you also take economic kind of principles and you kind of layer that over the housing market. You have a very unique both experience and data aggregation. Really appreciate what you do. And I had to read that article because I don't see the market that way this fall, but
Cool.
I appreciate the opposite opinion. So nicely done. It was a great article.
Yeah, I'm a data geek. I got a master's in agricultural economics, worked for USDA for a while, worked at the American Embassy in Paris for a couple, 3 years, and then came back to Arizona. But I like numbers. I like to find out, hey, what's the secret buried in a pile of numbers is what I like to find.
That's exactly yeah, I'm looking for the dull needle inside a pile of sharp needles, right? So not only needles, I want to find the one that's dull because it's like a fun treasure hunt for me.
Yeah,
So I like that. But before we dig into the article, I would be remiss if I didn't talk about the Arizona or Phoenix housing market you were on, I think 3 or 4 months ago when inventory was almost straight up. We were at numbers not seen since, I don't know, 2018, 19. All hell broke loose. What's going on now?
Yeah, wow. Okay, so the market has actually gone down. So Phoenix was for, gosh, a couple of years was the fastest appreciating market in the whole country. And it peaked in May at 515. Just looking at single family, non-distressed sales, median through the MLS was 515 in May, and now it's 480 in August. So that's what is it? That's a 6% fall in 3 months. So that's a ton, and that's so different than in 2005. 2005 it peaked, but then it was flat for a year, more or less, and then started falling in the fall of 2006. So this is different than the fact that it's happening so fast, but it's a concern. But the real mystery, though, is very different from 2006. Is that it's the inventory was skyrocketing for a little while, and now it's flat. I mean, it's high. It's higher than it was in 2018, but it's not going up anymore. Where in 2005, holy mackerel, it was just like a rocket for like 2 years.
I was a very active buyer. My market was very much like Phoenix. It was just like in my market, every Monday new stuff would come on. It became a process, right? Every Monday it's a new book, a new set of properties, new foreclosures. It was a process. And I seen in my market kind of the same thing, right? We had that post July, August kind of, oh my God, honey, we missed the peak. Let's get out now. Inventory flattened. And actually in my market, it's down now. I mean, it's not down a lot, but I think we head into winter, active listings are actually going to come down. Do you think Phoenix might see listings come down, or no idea?
I don't think so, because traditionally the seasonality is it go up in the fall. So you would have to go against seasonality, which I don't see that happening.
And then the last question about Phoenix was, I believe you shared with me, I think Open Door had something like 1,800 or 2,100 or some, just like more than 10% of the market was Open Door listings. Is that still, do I remember that correctly, or maybe I'm confusing things?
I don't remember the number, but it's huge. And they're really trying to get rid of that inventory. They're cutting as much as somebody was doing a research. They found one where they cut the list. They sold it 20% less than they paid. I mean, that's an extreme, but nevertheless, they tend to sell less than. They make a little money on their fees, so they're not losing money because they have fees of what, 6%, 8%. I'm not sure. So, but nevertheless, they are on average selling below what they paid for the house, and they still have a ton of inventory out there.
Yeah, I think that's one of the things. There are definitely markets. I think Phoenix might be the top of the top markets that are dominated by iBuyers, and iBuyers got to figure it out. My people are telling me they're not buying nearly as much. Obviously, have a problem selling. Do you think they're still actively buying, or do you think they're trying to lick their wounds and try to figure out what's what?
They're still buying, but way less than they were. Okay. It's a tiny bit. One of the things that happened back in the summer was there was a big boost in homes hitting the market, and that's not happening anymore. I think it was a lot of the flippers, et cetera, were just like, hey, let's get rid of this inventory. So that was hitting the market, and they weren't buying more. So the thing that's keeping the market, even though we have really low sales now, we have really low number of hitting the market. Now, here's the mystery for the Phoenix market right now, is you look at really low number of homes hitting the market, but it's the expensive homes. Like if you look at like from 2,000 square feet and less, holy mackerel, we're off the charts. We're way more homes listed for sale under 2,000 square feet than in 2018, which is a kind of a normal market. But if you go to stuff that's like super large, like 5,000 square feet and above, that's where it was a little bit more than last year. It hadn't really changed. So there's something, a bifurcation going on there in the market. But if you have a house that's under 2,000 square feet, you got unbelievable amount of competition right now.
So I actually think that is, and again, you're the guy that knows Phoenix. I don't, but I believe that if you were to kind of layer over the percentage of what iBuyers, in this case, Open Door own, I'm going to guess they own a lot of homes sub 2,000 and not a lot of 5,000 square foot homes.
Totally.
I think it's a compound effect. I think Open Door's got a hard pivot. They got to figure it out. They bought too high, they bought too expensive, and we'll see if they're still around in a year or so, because it seems
there is one scenario. This is maybe a little slight scenario, but let's say you can't. It turns out that we got a ton of inventory a year from now, and if you want to sell, you'll just say, okay, I'll just sell Open Door. Make it easy, because now you'll pay their fees. I assume their fees are going to go up. Let's say you pay their 10% fee. It's not
going to find better
now.
margin. Yeah.
It's not going to be 10% now, but it's like, let's just move on with our lives. We got other things to do. Let's just sell the house.
Yeah. Again, we'll
I'm
kind of
not saying that's going to happen. That's just
that's just
a possibility.
Yeah. One of the things that I'm seeing out there, again, I know my market, Fresno, California, and then I look at national numbers. I don't know Phoenix, any of these other markets, but my general feeling is phase one of the housing crash in transactions was demand destruction. Kind of easy to see, right? Rates go from 3 to 6, now from 6 to 6.7. Who knows where they go? That's easy for people to see, because you got a yes answer at 3, you get a no answer at 6. What I really expect to surprise and shock a lot of people is some supply destruction. Now, Phoenix is weird because it has an iBuyer domination, but when you look across the country, with rates now over 6.7, what do we got? Like 85 or 90% of loans below the existing rate. There's just less motivation. What I see coming, John, and I want your feedback, is a very, very, very slow winter. People are going to go, you know what? We'll just sit tight. I'll wait till the spring. We'll listen in the spring. It's usually better. I just see the next 6 months being way slower than traditionally speaking. Does that kind of feel okay, or am I off?
Yeah, that feels totally okay. And also for those people, because of the low rate, how many people are going to, when they sell, they're going to rent it out if they can't afford to buy another house. So that is another little squeeze on the supply, because they keep that 3% and rent it out. And
why wouldn't you? I mean, I mean this with all seriousness. That 3% mortgage, 30-year mortgage, could be the best asset some of these folks ever own. I mean, it really can, right? In a world of 7 and 8s, 3 sounds a lot better.
Another thing people don't talk about, but it's so obvious, is with high inflation, that's great. Your real mortgage payment just went down 8% this year. You were thinking, so holy mackerel.
Yeah, so I think there's
not just this year, for the entire rest of your mortgage, it's gone down
exactly,
and less than you expected.
It'll more than you expected, right? Yeah. So I have a shirt that actually says, "I use inflation to get rich. Ask me how." This is an example, right? You have fixed rate debt. Inflation just eats away, so you're paying off the debt with cheaper dollars. It's a whole thing that you're aware of. But yeah,
my son bought a house in Florida this summer, and I said, "Hope for inflation."
Exactly. Just hope for inflation.
And I also told him, don't be surprised if 10 years from now it's the same price you paid, as long as you're okay with that and you can handle that.
Yeah, like Fort Myers. There's it's amazing to see markets repeat kind of the same run up that they did last. I think Fort Myers is a great example. It went up 73% the last time, and it's up 73% this time. And
wow.
We'll see if it comes down. That was actually by John Bird's Real Estate Consulting, as you know, a great follow on Twitter.
Oh my gosh, yeah.
As you are. So back to the final thought about, because I think we've entered phase 2 of the housing crash in transactions, and it's what most people are missing. You see it, but I think most people miss it. Certainly all the novice YouTube real estate predictors, and that is supply destruction. We haven't really experienced an environment since the early 80s, like 80, 81, of supply destruction. In 80, 81, the lending environment was totally different. But again, when you double interest rates, which happened in the 80s to 81, you do get sellers who can't sell, right? And you do silent seconds and you get creative. So I think the next couple of years will be the land of creative financing, because some
remember assumable loans.
Exactly. The 80s, baby. The 80s. Yeah, exactly. Because we still did 2 million transactions, right? Housing transactions went down 50% when rates doubled. It was because of assumable loans, silent seconds, all of these things. But I really think what started in September, so it's only, I don't know, a couple weeks old now, and it will go through March, is supply destruction. And I think most people are missing it. And that could, and we'll get to your article next, keep prices relatively flat. Now, you take demand down 50%, but you take supply down 60%. And again, these are just made up numbers. You know, it's not all equal. I think too many people are expecting supply to keep running off because that's what happened last time. We joked earlier, right? Once supply hit, it just kept building and building and building. I just don't see it, at least for the next 6 months. When we get to March in the spring selling season, we'll see where we're at in the economy. We'll see where rates are. You know, this is what I'm thinking. How does that feel?
Yeah, well, on the one hand, I was talking about how the prices fell in Phoenix so quickly. So I was thinking things are going to happen faster this time. The cycle's going to be faster because of information on the internet and all that. But on the other hand, what you're talking about slows down the cycle so much. If people don't have to sell, you don't have all these investors in 2005. They were buying, they weren't even renting it out. They were just going to hold it for a few months.
And they were flipping paper. Yes.
And so they had all this supply
and winning
ready to,
and winning.
Oh, they were doing great.
Yeah.
And so they had all the supply hitting once they saw it. But now it seems like rent it out so that you buy it and then rent it. Well, there's some flippers. And I think a lot of the flippers that are out of the market now, the number of flippers, gosh, is way down.
Yeah, I think there's I'm actually calling it I don't know what I've called it. Whatever's worse than a winter. It's a snowstorm, a frozen tundra. we're gonna, I think we'll be under 4 million annualized transactions here very soon. And obviously we peaked at nearly 8 million, I think 7.9 when you add new and existing. It's just going to be a really, really slow. And again, when you do all of this, price will just be, I see prices being relatively flat through March. And then I have no idea, post March.
So Mike, you're saying winter is coming?
I'm saying winter is coming, but housing depression. Yeah. Yeah. Winter is coming in winter. It's very interesting, John. That's a great prediction on my part. Thank you for pointing out the obvious.
I'm a little biased on, I tend to run bearish anyway, but to be in Phoenix, shapes my fear that prices could really start, and we could get this feeling that once they keep going down for a certain amount of time, then people start changing their ideas about the market.
No, that's exactly right. And this is a great transition to your article, right? I'm going to bring it up just so people realize I actually did a video yesterday where I read the entire article. I talked about all the great things, all the economic nuances. But let me bring it up just so people can see
Thanks,
it.
Mike.
And then we'll talk.
Appreciate that.
Of course. No, I think you do a great job, and you're giving me new things to think about. So I appreciate that. So I found it on Yahoo. It may be other places. Obviously, it's probably on Fortune, but I found it on Yahoo. But this is the article. You're familiar? Yes, John? Just making sure they didn't sneak it in on you. But why don't you talk about basically your theme for this article? Because I think there's lots and lots of things that are nuanced and important. A couple of things that nobody has ever said that paints the 08 through 10 crash in a new light for me, but also, at least on a national level, I don't see happening by the fall, which is obviously we're kind of into. But let's talk about your premise and what were your important nuances in this article, because there's so much here.
Yeah, I just looking around on the internet, I knew that there was this idea of price expectations. Then once prices start going up, then people think they're going to go up in the future, so they're willing to pay more and they're willing to buy more, and so that causes prices to go up even more because their expectations are so positive. And then so it becomes this feedback loop where prices just take off on their own, having nothing to do with the other fundamentals. Is just they see everybody else, and then there's kind of a herd instinct thing going on there. So I started looking into that, and holy mackerel, there was a ton of academic research papers, and they often call it different things. They had different names for it, but the whole idea is it's irrational. So there was a whole idea like in the 70s that the markets are rational. Mm-hmm. And it seems to, but it turns out that they would tend to be irrational in the same way. It's like you would think, okay, if prices are going to be up 5% next year, and you ask people now, like half the people will think it's going to be 5% or above, and half will think it's 5% or below. So that is normally, it's on average, it's irrational. That's not the way it works. When prices are going up, there tends to be everybody, not everybody, but on average, people tend to overestimate the future prices. Yes. And when and even in like 2006, and 7, people still thought prices were going to go up. And even after the bottom on the other side, when prices were down from 2012 to maybe onward, they thought prices weren't going to go up as much as they did. They had this, they saw them go down so much that they had this bias that prices wouldn't go up as much as they actually did. So anyway, it's a lagged effect. They call it extrapolating. Whatever the prices are now, people just extrapolate those price trends out into the future, whether it's up, down, or sideways. And so that's kind of the idea, that can take on a huge effect. And it could be, I think the price effects like now could have an effect for like 2 or 3 years. It's really slow for people to change. It's an emotional thing. It's more how long does it take people on average to change their emotions towards the market?
Yeah. No, it was great. It was something that was very nuanced, something I had never thought about. I have an econ degree, master's degree. I've been in the housing market business for a long time. I'd never seen it. When I read this, and I've read the article a dozen times because I knew we were going to do this discussion. The more and more I read it, John, the more and more I understood why 06 to 10 or whatever year time frame you have, why that was so bad. Because what we had in that environment, people talk about, bad lending and, 103% mortgages. All of those things are true. But your article points out a lot of it was consumer psychology, right? When you saw prices go down, and then I believe you saw your neighbor sell it short and get out from under it, right? The strategic default went from being this horrible thing to like, hey, a badge of honor. And that really led to year after year after year of just kind of growing. And then, it just came all the way down. And then to your point, I was buying this whole time. And then in 2010, when you were buying properties for less than land value, everybody thought they'd go to zero. I'm like, what are you guys thinking? This fundamentally can't go much lower, right? The math doesn't work. And, you had people calling for housing crashes since 2011 and 12. And I'm like, I mean, at some point, this is just illogical.
Yeah. So there's a thing, Howard Marks, I can't think of where his company he works with. He's a famous guy who writes in his letter. He's like a hedge fund. He said, quote, "So the change in an asset price is based on a change in fundamentals and/or a change in how people view those fundamentals. So it's how they view the fundamentals can change as well as the fundamentals and have a similar effect. So that's why they can go off way too high or too low for like years at a time. So
so
I'm just worried. I hope this doesn't happen because I was so bad. You'd sell a house to somebody and then you notice a few years later they got foreclosed on. That's horrible.
Yeah, it's not a good feeling. Yeah. I mean, as a real estate agent, to help somebody get in and hand them the keys and you take the picture and then 2 years later they're in a bad spot, that I'm sure that doesn't feel great.
Yeah. So I hope that doesn't happen. But when you look at some of the things like the income ratios, like how expensive it is, it's like prices are like 40% higher than they were 2 years ago. How can that, it's not sustainable.
Yeah, it's not. So there's two things that I think are very true today. One is it's unaffordable in most of the country. Even in my market. My market bought. So we have an affordability. I don't know what Phoenix is. Mine is 0 to 100, right? Anytime it gets below 25, I get nervous. And frankly, if it gets below 25, I might sell stuff. For most of the last 2 years, it was over 40. The last month reading was 31. And it's going to get worse because rates have jumped a full point. As you know, it's rate, price, and incomes. It is bad and getting worse. I'm not confused. But again, what I see just in the short term for me is 6 months, is I believe what we are going to see this cycle, at least until March, is homeowners, which is the second part of a transaction, right? There's demand that is horribly low.
Mm-hmm.
But the supply is just not going to show up because, again, unlike 06, which both of you and I went through, it's almost like a Tina trade. There is nowhere else, right? Where's this homeowner going to go? They can't buy anything else. What are they going to do? Rent? A rent payment is above their mortgage payment. How does that logically make sense? I just think there's a lot of people in a scary economy where the house is the asset. The 3% mortgage is the asset. People will let go of their car loans, right? They'll let their car go before they let this house go because unlike last time, the value's not cascading down. Rents are up, not down. It's now, who knows what happens in March? In March, interest rates are 9, unemployment's 9. GDP is down 4%. It could get ugly, but I just don't see it this fall. I think this fall people just retrench and go, I'm scared. And when people are scared, they do nothing. That's what I think's going on right now.
Yeah. Oh, they're confused. It's like
Or confused, yeah.
2020. It's like, what's going on? I couldn't figure out what the heck was happening for months and months with the market.
Yeah.
And I think we're going to have a lot fewer foreclosures. One of the things that really killed the market last time was the foreclosures. That, oh my God, they would just sell it for anything. They didn't care. It was great if you're an investor. If you're an investor in 2005, you were probably out of business by 2006.
Yeah.
But nevertheless, this next group of investors did really well by buying them at the courthouse steps. And then, but I think we're better at that now. That's just a guess. That the government won't allow that to happen. And you saw the moratoriums on foreclosure moratoriums. They would just say, oh, we did that 2 years ago. Let's do it again. So that kind of,
yeah.
So I don't think we'll get those foreclosures really. So it'd be more like the savings and loan bubble where it went down for a couple of years and then was flat for 5.
Yeah. The other thing about, I think you're right. This is not going to be a national thing. Because again, banks are different, right? They know about forbearance. The Fed, believe me, if unemployment goes from 3.7 to 10, forbearance will be a thing again. It just will. They've already proven it work. Why not do it again?
Yeah. Before it was unthinkable in 2005. Yeah. Now it's like, oh, whatever. Yeah. Okay, sure.
No problem. So I agree with you. I do like your comparison, the S&L crisis. And again, I've done plenty of research on this. The thing I like about the S&L comparison, savings and loan comparison, is it was very regionalized. Some markets were hurt much more than others. And I think that absolutely happens. And Phoenix and or Vegas might be the tip of the spear, but I don't think you extrapolate what happens in Phoenix to the country, in my opinion.
Yeah, it's the worst case scenario for some reason. I assume it's because the number of investors just really, we got a fixed supply of homes. You just added 5% more buyers who are investors or 10% more.
Well, I think exactly what happened over the last 2 years is back to your mindset of investors, right? The getting was good. More people came, and then you started seeing increasingly newbies overpay. And frankly, I think Open Door was the main criminal. I know people in Phoenix whose whole model was to flip to Open Door. When you know there's a sucker at the poker table, you take their money. Open Door was the sucker. I know people that made 7 figures 2 years in a row doing nothing but selling to Open Door.
Wow.
If you figure out their business model, go take their money.
I know a guy who was trying to analyze their algorithm, and he found, I guess if you figure out their algo, you just
figure out what again, I call it a buy box. I'm sure they call it something else. What was Open Door looking for? 4 or 5 bedroom houses, 2.5 baths, single level, whatever it was. Just go get Open Door what they want. And they made a lot of money doing that. And now's the reverse. Now I believe there are some markets, because Open Door to me is a bank like last time. Banks are not emotional. There's somebody like me or you sitting in front of a computer with an Excel spreadsheet with all the lines, APN number this, APN number that, how long it's been listed. Oh, by the way, what's our cost basis? Sell it. We have reserved for bad debt. We've got to get $1,700 off our books. Sell it. Take any price. I think that's what's happening. But that ends. As long as they're not adding new supply, that 2,100, that ends. It will be painful. You're going to get a big drop, 6%, 3 months. Maybe it goes 9 or 10. But eventually you won't have Open Door's anvil pulling the market. And again, then you just get to a very slow market because buyers is unaffordable. Mom and dad aren't selling. It's weird environment.
But getting back to the article, let's say the price has been flat for 6 months or 9 months. Now people aren't confused anymore, thinking, okay, this is temporary. Now they're thinking, oh, they've been flat or down for 6. I guess so they're mostly thinking, okay, prices aren't going to go up anymore. They're might go down. And then after a while, they think, oh, they are going to go down. Then what do you do? That could change the whole psychology, but that's a slow train to change people's sentiment.
Yeah, it absolutely is. And again, I think we have 6 months of retreat, confusion, what's going on. I think the big question for me is going to be interest rates next year, because again, consumers have you and I have great memories and experience, and we try to tie things together. The average consumer, they're going to be very quickly conditioned to 7% mortgage rates, right? That will just become standard. And then let's just say the Fed pivots in September or January of 24, and suddenly mortgage rates are 5.8%. That will feel like a gift.
Yeah.
It just will, right? If you've been waiting this long and you got used to 5.8 feels better. And then, buyers, but again, who knows what rates be? For all I know, they could be 9.2% next year. But those are things that the consumer's memory is not great. They forget things pretty quickly.
Yeah. Oh my gosh. I'm thinking of like first time. Oh, this is a trope, but people were happy when we paid 9.9 on our first house in 2000.
It wasn't double digits, right? It
I
wasn't
mean,
double digits.
87.
Yeah, I was going to say it had to be 87. Yeah. But again, people get conditioned. And again, I did a whole research all the way back to the 1970s. I've seen what happened to housing when rates double. I've seen what happens when you have 40 years of declining rates. We are not in that environment. But again, what's happening right now is rates are exploding so fast, you have no time to get recalibrated. They were 3% January 1st. They're now 6.7 or higher today. That's just causing people to pull back, demand destruction, supply destruction, the move up market. It's just the Fed broke the housing market, in my opinion.
The Fed is like, housing is the whipping boy for the Fed.
Yeah, it's most leveraged to the debt.
Yeah,
absolutely.
The most sensitive to their changes in interest rates by far is housing. So when it goes up, they go crazy. When it goes down, so they're and it's the most important asset and the biggest asset for most families. And the Fed is just playing with their wealth. I wish they could figure out another way to try to save Wall Street instead of messing up Oak Street.
Oh, yeah, exactly. Punish Wall Street, but save Oak Street. I like that. I'm going to steal that, actually. I'll give you credit the first couple times.
Okay.
But then it will be mine.
Instead of Main Street. Yeah, Oak Street.
Yeah, Oak Street. I like that. But yeah, so let's talk about kind of what you see, because I love the article. I understand all the logic. It was unclear to me if you're making a call on the national market or if this was an intellectual exercise, which was awesome. It helped me. It helped bring clarity to me about the 06 that I never had before, or 08 or whatever your time frame is. I don't see it playing out this fall with negative numbers.
Totally. Could be.
Maybe after March, that's absolutely possible. But again, we've got to get from here to there in my mind. Do you think national prices will be negative this year?
I think they could be going down by December, for example, nationally. And I could be wrong totally.
Yeah. We're just both guessing, clearly.
Yeah. And I should mention also this whole idea of these expectations and how it causes booms and busts, et cetera, that's not for sure that's going to happen. For example, in 2006, Canada avoided it. One, they had like minimum down payments and shorter loans. They had a lot more people that own their homes outright and didn't have as much debt. But the real thing was that oil prices skyrocketed. And that was a huge part of the Canadian economy is oil. Yeah. So their economy was doing great. And so they went down a little bit and that was it. Now, the problem now is their prices are off the charts. And they started tanking a few months ago.
Yeah, Canada and New Zealand are the two markets that I think are legit going to be a crash for all of the reasons you've just talked about. But most importantly, their debt structure. Their debt structure relies, I think it's like 90% of them are 5-year arms. I'm like, can you imagine?
Yeah. Oh my God, they're going to get, oh my God, that's really going to hurt. With New Zealand and also with Australia, they had this big boom with China. They were exporting coal or whatever they export to China. So they had a big boom right when the housing market, so they didn't come down that much. Plus they had another program where they would do like tax credits for first-time home buyers, and that helped too. So they didn't get the correction, which was great until people were thinking, hey, prices never go down here. So they became even more okay with paying crazy prices for houses, and they might be getting an enormous correction this time.
Yeah. The other thing I'd love to hear your opinion on, sort of as an experienced economist and somebody who's deep in the housing information, there's really kind of 3 metrics that I look at, and I'd love to see your order of these. One is obviously there's year-on-year metrics, year-on-year price, year-on-year. A lot of housing statistics are year-on-year because of seasonality and all of that. Then there's month-on-month, right? When do we have trend reversion? Things is it faster, right? All of that. And then for me, what I try to talk about in teach, frankly, is forget all, if you're just a mom and pop investor, forget all of that stuff. Let the economists play with month on month and year on year. You get your buy box, right? And oh, by the way, your buy box is not Phoenix. It's some zip code, some asset type, some size. It's really small. All you should be doing is looking at that every day and tracking what's going on in your buy box every single day. Inventory, price drops, closings, cancellations, expire. Focus on your buy box, because who cares what's going on across the country year on year or month on month? It's for you day on day. What do you think of that? Do you look at year on year at all? Do you look at month on month? And then what about day to day?
I don't like year on year. That's ancient history. So, but month on month would be see what's going. What I'm trying to predict the future. What to expect in the future is looking at recent trends, and then I extrapolated out. Okay, they're going down. So things are getting weaker than the people thought they would. But what you said, like there's always going to be opportunities, people that have to sell now, and whatever. So you can get that. There's going to be fewer of them than when there was like a zillion on the courthouse steps every day,
Right.
but nevertheless, take more work to find them, but they're there.
Yeah, no, I think there's, I have a saying, it's always a great day to do a great deal. I think where most people get it wrong is they don't do the work to figure out average. Right? Great deals don't just land in your lap. You have to do the work. You have to have the discipline to understand what's going on in your market. And to me, market is, what is the average? For me, it's yield, cash on cash, right? What is the return, right? Cash in versus, down payment, closing cost, repair, expected yearly cash flow. That's a yield calculation or a percentage calculation. You do the work to find average. Let's say average in Phoenix is 1%, or say it's -2. I don't care. Whatever the number average is, always do better than that. And great means significantly better. So if average is 2%, go find a 7 or an 8. If you're in Ohio and average is 10, go find 15 or 16. Do the work. Don't buy average deals, especially the next couple of years, because we don't know what's going on. Don't rush. Don't blow everything right away. Just do the work. I am so afraid, John, that people are being told a crash is coming, that they're not doing the work. And that frankly scares me.
Yeah, there's always going to be distressed sellers.
Yeah. You don't judge a seller's motivation, right? They may have owned the house for 20 years, have a lot of equity. They want out. They want to go to, New York with their kids or whatever. I get this all the time. Why would a seller do that kind of deal? Don't guess their opinion. Ask them. There's always great deals to be had.
Yeah. On a related subject, talking about a little bit of a change, I'm talking about, there's another theory called the leverage cycle. And at the top of the market, there's other things happens. Like the one thing in that article that I wrote was talking about how the lenders are caught up in that too. So when prices start going up, they start easing. I mean, this is a lot in the academic stuff. They start easing too. So you get this mix between the buyers or the market participants plus the lenders. And so they feed on each other. But then when they start tightening, it comes down. So I'm thinking of the Burr guys. So those were the most optimistic buyers. And there's a theory, a guy, where is he from? Back east, some academic guy, talking about the most optimistic buyers set the prices. They're the guys who set the prices, whether it's stocks or particularly in homes, because in homes, You're not just buying the house, you can pay more. So it makes the pricing go up faster, because if you're optimistic. So all those Burr guys are now out of the market if they were really, because the prices aren't going up anymore, so they can't extract it. If they do extract it, they can't get it at 85, 15% down. They got to do 20, 30%, whatever. So they're out. So now the leaders now for prices are people who are a bit less optimistic. So that helps, another factor within this whole price expectation thing.
Yeah, and again, I read all of it. I read it 12 or 13 times. Again, that goes back to exactly what happened 05, 06, before the peak. So we haven't talked about this, but I was declining tenants for my rental units because of credit and income. They were being approved for houses with 103% mortgage.
That's what killed it. That's what killed it, was 103%. That's
exactly
what caused all those foreclosures, which and then people just will sell it at any price. It's not my job. I'm just the servicer.
I don't got any skin in the game. Yeah, exactly. So that's not happening now. As you know, loan quality much better. Heading into this year, 98% of loans are fixed rate. Now, I think the latest origination was 13 ARMs, but the average duration of an ARM today is 7 years, where before it was sub 3. Lots of different things different in the loan book today.
But what do you think of that idea about Burr being the most optimistic Burr out of the market now?
I think that is genius. I think you're absolutely right. Absolutely.
I'm just guessing. I'm not
No,
involved.
it's funny. If you were to go to my channel and look back a week, I did a video about Burr and bankruptcy. Basically the same message. Burr is a advanced strategy sold to novices. I think that was the exact title of my post. Burr is an advanced strategy sold to novices.
But it worked great. What are you talking about?
It worked great in the greatest up market of my generation. It won't work in a flat market, and heaven forbid a down market. It's gonna ruin people.
That's scary.
Yeah, but again, when you look at the percentage of Burr transactions, for like when you look at the buyer pool, the last I saw it was I think they said 28% of buyers were investors, rough and tough in August.
Depends how you measure it, but
yeah, close enough. When I look inside that 28%, this is just a wild ass guess. I would think Burr was, I don't know, 3 to 5%, because some of that 28% is really a second home. It's not really an investment. Could it be 11%? Sure, it could be, but yeah, there are going to be a lot of people in pain. If you borrowed money to do a Burr, like you borrowed the purchase and the repair, you're toast. You're going to lose money and be out of the game. Yeah, I think some flippers, like the other part of the market that I think is really in trouble, I think we talked about this earlier, is luxury, right? Luxury, according to the last research I saw, was down 28%. Whatever you define luxury as, I typically say 2x the median. That's where the flippers got crushed last time, and I think they could get hurt there again. What do you think of that?
Well, here the luxury prices are not selling, but they're not going on the market. It's just like
they're being pulled back. Yeah, okay.
Yeah, so they're really tight. The supply of luxury is surprisingly tight, because I don't know why exactly. That's a mystery to me too. It's like, why aren't luxury? I guess they think it's a good investment, or it was a second home, or
I think they're going to limp. I think they're just going to hold on and pray. This is what happened last time. I knew a guy that was worth 10 million bucks, all equity, all paper wealth. This was in the Bay Area, so he had $5 or $6 million flips going on. And this is $1 million flips 06, not recently, right? So totally,
when it was real money.
Yeah, it was real money. Exactly. But I remember one house he had that he didn't want to take a 50K loss. It would damage his ego, or he just couldn't take, and he could have afforded it. That one decision started a cascading of dominoes where he went bankrupt and lost everything. So flipper, sometimes when you get stuck and you have this ego, like if you, like the last 2 years have been the best years ever to flip. Some of these folks don't realize that the market made them, and they're going to let their egos write checks that their ass can't cash, and they could be in a lot of trouble. But it won't be fast. It will be next year, right? They're going to suffer through some negative cash flow, and rob Paul to pay Peter, and it's going to get really, really messy. But there will clearly be some losers coming out of this for sure.
Yeah, but I think also because of the age of the internet, things are happening faster on the one hand, but on the other hand, you have these other things that are slowing it down. I don't know how that shakes out, but I would be cautious that things happen faster than you expect on the.
I think that was very well said. And so far, you're right. Everything kind of the last 12 months is happening faster. The speed of information, consumption of it, pivots are faster. I think you're right.
In Phoenix, the price is going up. We're faster.
You're right. Both sides, both ways. Yeah.
On the way up. So it's like, holy mackerel, I hope they don't go down faster than they did in 2007 and 8.
Yeah. So on my daily financial news this morning, when I talked about the housing market, because it's where I spend all my time, I said, this is what I'm looking at today. The number one thing I'm looking at is active listings. Because again, in my market and nationally speaking, don't know Phoenix at all, it's falling. And not a lot of people are seeing it yet. Now it's down slightly, but I do think it will pick up steam as more and more sellers decide not to wait. And cancellations are up. Cancellations are up 300 to 400%, which a lot of people aren't talking about as well, right? Meaning mom and dad put it out. Nobody came to the open house. They canceled. I think expireds will explode. Usually a contract is 90 days, sometimes 180 days. I think expireds are going to explode. So I am personally watching active inventory is kind of the number one thing I'm looking at. What about you?
Yeah, well, in Phoenix, it was skyrocketing. Month supply is one, just looking for a single family, non-distressed. It was skyrocketing and hit about 3.2 months, and it's been there for like a month at 3.2. surprisingly in that area, which to me is almost normal in my mind. Like
Yeah, it's close
what,
enough, right? Yeah.
4 to 6 is normal.
Four
Where
today,
prices don't
probably.
go up. Prices
Right.
don't go up when you're at 4 to 6. But
Yeah.
it's at 3. So that's
That's an interesting number because there's two variables that can make that
yeah.
stay flat, right? And that's why to me it's all about listings because again, in an environment where we already lost 20 million on the demand side, you can actually have falling supply and days on market or months of inventory it could still go up. You could have less supply and months of inventory go up. That actually happened in Fresno just last month. We went from 1.9 months of supply to 2, but active inventory went down, but it was because demand went down more, right? So there's all kinds of stuff going on.
Are people just thinking, oh, let's wait it out? Like they think things are gonna.
I think we have 6 months. I think things change so fast. Nobody had a chance to recalibrate anything.
Yeah, it happened so fast. Emotionally, they're still living in the past.
This is like, what? We shut down the economy in March? What the heck? Right? People are just pulling back. That's exactly what I think is happening is everybody is going, oh my God, I hear the media talking about a recession. I hear about unemployment. I want to be a little more conservative. I don't want to sell because I can't move anywhere. I just think the next 6 months, active inventory comes down. Buyer demand is not going to go up. I'm not sitting here telling you demand's going to go up, but I think supply is going to shock people to the low side in most markets, maybe not Phoenix, but active listings are coming down. And I think that just keeps things flat until March. And then in March, we have a decision. Are we in a nasty recession? World War III going on? I have no idea what March is going to look like. I'm so confused.
So right now, there's always something that's surprising me. The thing that surprises me now is there's so few new listings hitting the market, and that's keeping things tight. Now,
Exactly.
I don't know exactly what's happening there, but I wish I could figure that out because maybe I could get a better idea. But my tendency is to think, okay, we're heading into this time of the year, the seasonality where they go up. Plus, they've been going up tons, so maybe things start changing and people start listing. But
yeah,
I don't know.
I'm sitting. I'd love to talk to you in a month or so or get an email from you. I think active listings are going to shock people to the downside.
Did the downside? Okay, I would say for sure on the upside, at least in Phoenix.
Yeah. So again, let's put. Do you know what active listings are roughly today? Is it like 8,000 or 8,800 or something?
Oh,
you can send me a note. We'll just put a line in the sand and then we'll check on it the next couple of months.
Okay. Yeah. Let's
just for fun, right? Just for fun. Again, Phoenix may be very different because of open door iBuyers.
Okay. It's 15,500 for sale, single family.
Active listings. That's what that is.
That says for sale. Yeah. Active listings. Yeah. And that's higher than in any time in 2019.
Listen. So 15,500. I'm going to put this on the whiteboard where I track calls.
That's single family, non-distressed.
I totally get it. So what you're saying is by the end of the year, December 31st, we will be above that.
Oh yeah, totally.
Okay. All right. I'm going to call below that.
I have little doubt about that. It's just, is it going to be significantly above or just?
Yeah. Okay. I like it. Yeah. We will
and the real thing that happened in the market here is we had a ton of, we had sales tanking after the interest rates went up, but we had a surge of listings in the summer.
Exactly.
And now we don't. Now the listings are like, so they're kind of imbalanced between the new listings and the sales.
Yeah, that's
even though the sales are at very low levels.
Yeah, I told my folks on July 15th, and the beauty is all the videos are there. I said July 15th, which was obviously National Association of Realtors report about June data, was when the market changed. Demand was already being crushed because of rates, but what happened is you were going to get 6 weeks of FOMO from sellers, which was a new phenomenon, which was going to flood the market. At most of those would be wish pricing. So it would be fake inventory, right? Trying to sell a 400 house for 500 grand works when there's nothing. It doesn't work in that environment. Hence, inventory artificially skyrocket, and then it will be bleeding off going forward as cancellations and expireds happen. So that's what I'm seeing.
Hey, if you want to talk about risk, Mike, here's a huge risk we haven't talked about is rents.
Oh, rents. Yes.
What if rents keep softening? And
I think I've called that as well. I think, and again, you got to be careful with rents because I break it in two parts. There's rents for apartments and rents for single family homes. We got to be very careful. Very careful.
Good.
I'm saying nationally speaking, rents and apartments have already peaked and are coming in.
Yeah. Okay.
Rents for single family homes. Again, a lot of the country has less supply into an affordability crisis, which increases demand. So I think rents for single family homes, again, nationally speaking, flat. We've already had stupid rent growth, non-repeatable.
Right. Stupid. Yeah.
Yeah. But I don't think, again, rents are sticky in an environment where nobody can afford to have a home and you want a home instead of having neighbors. I think in an economy where unemployment is still sub 5, I don't see rents in single family homes in the country coming down. I don't see them going up, but I just see flat because we basically pulled forward 5 years of appreciation.
Yeah.
Because of the stupid 2-year printing of money.
Hey, Mike, let's play a mind game here. What happens
Sure.
if real rents did fall
Sure.
to where they were 2 years ago? That would be like the worst case scenario.
Ooh.
What happens?
So
Will people still be able to
make?
You would think people would still be able to make the payment. That's still cash flow, wouldn't they? Or
So
unless you
again,
bought in the last year. And you've bought in the
that's
last,
the key.
That's
That's
it.
the key.
The people who
If
bought
you-
in the last 12 months.
If you, like basically, if you bought after January, when rates were 3%, you're going to be fine. That is an asset for everybody, homeowner or investor. But if you bought, like, I don't know where the break even is. It's probably 4.5. If you were a very recent buyer, or heaven forbid, got an ARM, you could be in trouble.
Oh,
But I think it would be a small percentage. But I mean, these things, I mean, that 3, I mean, we should have never had rates at 2.6, 2.7. We certainly shouldn't have had them for 2 years. That's what the housing market got broken.
Yeah, I think that was the big trigger right there was the rates. Because is there any industry that's more sensitive to interest rates than housing?
Oh, too
Because
low.
you can
for
leverage
too
up.
long.
The leverage is like what, 4 times what it is in the stocks, and
Oh, easy. Yeah.
so that's. So
Yeah,
anyway,
so
I just feel like the Fed is using housing to.
Oh, it's clearly the whipping boy.
Wall Street happy, whipping boy.
Yeah.
Yeah.
Yeah. So the other thing to talk about that I'd love to go back to, we talked about Burr being the ones that are getting spanked most. They're the most optimistic. I think that's a great insight. But I want to flip to who gets helped the next year. I actually think there's a part of the demand curve that was ignored for 2 years that will actually have opportunity and can keep a floor on pricing. And that is FHA and VA buyers. Right? They were basically ignored. If you were an FHA or VA buyer and you wrote an offer, you were just flat out ignored for 2 years. You just were. I'm in the industry, I know. But now, because there's no demand, you're suddenly being able to write FHA offers, get 3% buyer credits for closing costs, rate buy downs. You're getting closing costs paid for. You're getting all repairs done. You're basically buying a perfect property. So again, in an environment where transactions get whacked in half, I think the percentage of FHA and VA buyers goes way up.
Yeah,
right.
What do you
think?
makes total sense. That's what happened last time too. They filled the gap that the crazy people left.
Yeah, the crazy people left. You're no longer getting 100K over. But again, FHA buyers, mom and pop buyers, this is their dream, 3.5% down. They're used to paying list price or getting one, like the average purchase to list is now 99% or 98% for the country. So again, get a little discount. Don't pay list price. Get closing cost credits. They're going to fill in the demand curve. So we'll still have transactions and prices will be sticky.
Well, Mike, you're talking about prices. Somebody on the Twitter thread was mentioning the discounts, the closing costs, getting the seller to pay closing costs. You don't see it in the sale price.
Exactly. You see it in the net.
And so the net is changing. So maybe sales price, even though in Phoenix it went down to 6%, it's even more than that if you take into account. Also, if you take into account inflation, it's more than that. If you take into account the difference that the closing costs are being paid by the seller, then that's also
it's a very different game. But as you know, we report nominal price, which is the top number. We're not.
Yes.
We're not. Factoring out 3% closing costs. So again, this is why I think nominal prices are going to surprise people being sticky, at least through March. Transactions will go down 50%. And again, I think active inventory for the country goes down. I don't know about Phoenix. It's a very unique market. We have a number of 15,500. You're calling over, I'm calling under just to have some fun. Any other closing thoughts? Let me bring up the article. What would you like
So what do we got in this bet? Is this a nickel bet? Are we betting a nickel on this?
I like $1. I always like $1. It's a friendly bet. It's $1. When I get your money, I will create a plaque. It will be back. This will say John Wake's $. I will do that. Not a problem. Feel free to do the same. And again, the date's December 31st, just so it's out there and recorded. Let me share your article one more time and tell people, this is the nuances and the important things. Because again, I took a lot for this and I've been in this game for 30 years. Any particular part of it you want me to highlight?
If you scroll down, there's the part of the article that's highlighted. In fact, if you can find that, that's kind of the summary, the
Oh, here we go.
takeaway.
This one?
Yeah, that's kind of the takeaway.
Oops, sorry. So the takeaway is the demand will continue to fall for many months, regardless of mortgage rates, because people are slowly lowering their expectations for future house price increases. Housing demand is falling along with expectations for house price increase in the future. This is basically the buyer not betting on getting appreciation.
Right. So there's all those other regular factors on interest rate, et cetera. But you got to think this is also a demand factor and a supply factor too, is future price expectations. It should be incorporated in your mix of fundamentals you're looking at.
No, I love it. And this is why I looked at this. I love it. I mean, if anybody had experience through the last crisis, this article put that last crisis in under a lens I've never seen. Great job. I don't know. I obviously don't agree with the title, but it was a great intellectual exercise for me. And again, I'm wrong all the time. So prices
I couldn't resist, but the alliteration, I couldn't.
Oh, no, of course. I mean, it got a lot of clicks. It got me to click. That's part of the battle, right? You got to get people to read the great material and your wonderful insights. And it often starts with the title. So, John, do you write for anyone routinely? Where can we find your articles? Where should people follow you? Because you put out great stuff. I'm
mainly on Twitter at John Wake, but also I have a column occasionally on Forbes.com. So that's where I write there a lot. And then lately I've been writing on other places like Barron's. That was cool to get an article there. And this is the first time I was on Fortune. So that's fun because for me, I'm retired essentially. So it's a fun thing to keep me watching the market. So I'm still trying to, I had PTSD from 2005, et cetera, trying to figure out I'm still trying to figure out what the heck happened. Because I did not see that fall at all, that price fall at all.
Yeah, it's funny. I don't know if you've ever read my book, One Rental at a Time, but we were buying single family homes 02 to 06. We 1031'd out of houses because I could never make the cash flow work. It was all an appreciation game. So I got out, moved to apartments. Then the crash came and I'm like, God damn, thank God I got away from that. That's why I use affordability as my saving grace. Yeah. So
well done.
Got lucky. I'm not saying I called it. I just knew all I knew is I couldn't make the numbers work. So I went somewhere else. That's all I did. Yeah. It's pretty fun. So,
hey, well, here's one last thing on that Howard Marks thing. He said, he had a saying, he said, this is a saying in Wall Street, said the worst loans are made in the best of times. So I wonder if we,
yes.
So I wonder, I don't know the investor money, where that comes from, but I wonder if there's some bombs buried there.
Well, there probably are. So what has happened over the last couple of years is probably not going to be in the conventional market because generally speaking, the lending standards were, tight to tight minus. But there was a new space called non-QM, non-qualified mortgage, that kind of blew up because conventional was so tight. There could be some hidden bombs there for sure.
Okay.
Yeah. But that will be so again, it wouldn't be the 68% owner occ. It would be in the 32%. Then you take the 32% and you whack half of that because most of that's second homes. And then, you get to a pretty small pile, but there will be pain.
But nevertheless, I'm just saying it doesn't take very many foreclosures to tank everything. Because we were at a certain level, and last time we were at a certain level of foreclosure, didn't affect price, didn't affect because they were used to it. But then it got up, and I got to some point where it just started cascading, where people were saying, "Hey, that house over there sold. Did you see that house sold for?" And suddenly everybody becomes cautious. So you get the key to not having a crash is to limit the foreclosures one way or another.
Totally agree. Totally. Yeah, because there is a breaking point. We don't know where it is. And
it's a tipping point where suddenly
tipping point.
Boom. And
I agree. John, this is so much fun. Thank you for doing what you do. Thank you for coming back. Wonderful article. I will put the link in the description because people need to go check it out. Thank you so much.
Max. Really appreciate it. Take care.